Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Yesterday, during the midday trading session on January 22nd, 2026, AST Space Mobile stock didn't just move. It violently repriced reality. We saw an intraday high of $120.09 before the dust settled around 116.37. That is a 12.4% surge in a single session. And we aren't talking about a penny stock here. We had volume of nearly 19.3 million shares. But the number that is just flashing red on my terminal, the one that tells the real story, isn't the price. It's the beta. We are sitting at a beta of 2.7. For those listening who don't spend their days staring at Greeks, that means this asset is moving with nearly 3 times the volatility of the broader market. The market is screaming that something fundamental has shifted.
Or I think this is probably the more likely case. The market is screaming that euphoria has completely, detached from the laws of gravity. When I look at those same numbers, I don't see a fundamental shift. I see a classic textbook momentum breakout that's being driven by a liquidity vacuum. So we have to start with the central question. Is AST Space Mobile at a market cap now fluctuating between $38 and $43 billion actually a mature infrastructure asset? Or is this a meme stock scenario where retail sentiment is just front-running massive execution risk? Because a 12% move on no specific news, well, that isn't investing, it's a stampede.
I see why you might frame it as a bubble given the sheer velocity of the move. I mean, it looks vertical on the chart. But I would argue the market has finally woken up to a binary technological disruption. We aren't talking about a meme or a video game retailer or some movie theater chain. We are talking about the only player that has effectively monopolized broadband from space. The Golden Dome defense contracts, the Verizon and AT&T duopoly, this isn't speculation anymore. The market is pricing in the terminal value of a global monopoly in 2030, not the revenue of next quarter.
I'm sorry, I just don't buy that valuation logic. We are priced for absolute perfection here, and the technical indicators are flashing warning signs that we simply cannot ignore. The Relative Strength Index, the RSI, is hovering between 66 and 80. That is screaming overbought to anyone who respects charts. And perhaps most damning, the analyst consensus, the people actually paid to do the math on discounted cash flows, is still sitting 50% lower than the current price. When Barclays is at $60 and the stock is at $116, you have to wonder if the market is just discounting years of complex industrial scaling into a single week of price action.
Let's dig into that because I think you're looking at the rearview mirror while the market is looking at the horizon. Analysts are notoriously slow to upgrade targets during a paradigm shift. My thesis is simple. ASTS has transitioned. It is no longer a proof of concept gamble. It's a tangible implementation play. Look at the evidence from late 2025. The successful operation of Bluebird 6 proved that the proprietary phased array antenna technology works. That right there, that is the moat. Nobody else has unfolded a structure that size in orbit that can close the link budget, essentially the signal strength required, to connect with a standard phone in your pocket.
The technology working and the business model working are two very, very different things. You can have the best tech in the world and still go bankrupt if you can't scale it profitably.
But they are intrinsically linked here. Because the tech works, the strategy works. Unlike every other satellite competitor, ASTS isn't fighting the carriers. It is the carrier's infrastructure. They have AT&T as the anchor tenant. They secured that $100 million commitment from Verizon. By locking up those two, they have effectively locked up the vast majority of the U.S. mobile market. And financially, the $175 million prepayment from Saudi Telecom, plus the SHIELD program awards with that massive $151 billion ceiling, the balance sheet is de-risked. There is a layer of sovereign backing here that the bearish thesis just ignores.
I come at it from a different angle. You call it sovereign backing, I call it government subsidy reliance for a company that is still, pre-revenue in terms of meaningful cash flow. Let's look at the hard numbers because math has a nasty habit of ruining good stories. The projected 2026 revenue is only $193 million to, roughly $261 million? At a $40 billion market cap, you are trading at a price-to-sales ratio exceeding 200 times. That is astronomical. Even for a high-growth tech stock, that is nosebleed territory. NVIDIA didn't even trade at those multiples during the height of the AI boom.
Traditional metrics often fail to capture paradigm shifts. If you valued Amazon on PE in 1999, you missed the boat. You have to look at the total addressable market.
But gravity eventually asserts itself. The divergence from the 50-day moving average, which is down at 75.83, suggests this is a momentum trade. You mentioned the Verizon deal and the moat, but the market is acting as if the execution risk of launching 45 to 60 satellites this year is zero. It's not zero. The stock is priced as if the constellation is already up and printing cash, but the reality is they have a massive industrial ramp ahead of them.
I think that brings us directly to the mechanics of why the stock is moving the way it is right now. You mentioned the momentum, but there's a structural element here we need to dissect. It's not just excitement, it's the plumbing of the market itself.
Absolutely. We have to talk about the short interest. We are looking at 38 million shares sold short. That is roughly 16.37% of the float. Now, usually you look at days to cover, which is low right now at 1.76 because the volume is so high. But the absolute number of shares trapped is massive. To me, this looks like a classic gamma squeeze.
For the benefit of everyone listening who might hear that term thrown around on Reddit, let's break that down. When you say gamma squeeze, you're talking about the options market driving the stock, right?
Exactly. It's a feedback loop. As the price rips higher, the market makers, the institutions selling the call options, are effectively short the stock. So to hedge their exposure, they have to buy the underlying shares. The higher the price goes, the more they have to buy to stay neutral. It's like a snowball rolling downhill, just gathering mass. But look deeper at the dark pool activity. Over 3 million shares daily are trading off exchange. We're seeing 33 to 37% of the volume happening in the dark.
Which implies what to you? Dark pools are just private exchanges for large blocks, usually to avoid slippage.
It tells me that institutional sellers or hedgers are trying to exit or manage risk away from the lit market, the public NASDAQ exchange, to avoid triggering a panic. If they dump those shares on the open market, the price would collapse. They are terrified of the volatility. This isn't healthy accumulation where a pension fund buys and holds for 20 years. This feels like chaotic hedging by options dealers trying not to get blown up.
I'm not convinced by that line of reasoning. I'd argue the lack of liquidity is a feature, not a bug, of a tightly held strategic asset. Look at who owns the stock. This isn't just retail. You have Vodafone, Rakuten, American Tower. These aren't day traders flipping for a quick buck. These are strategic partners who need the network to exist for their own business models. They aren't selling. We even saw director Keith Larson recently buying more shares on the open market.
One director buying doesn't offset a 200 times sales valuation.
It signals confidence. It signals that insiders see the trajectory. The float, the shares actually available to trade, is effectively locked up by these partners and insiders. So when you have demand spiking because the market realizes this is the golden dome of connectivity, and you have 38 million shorts who need to cover, the price has to go up. It's valid price discovery in a supply-constrained environment. It's simple supply and demand.
More, it's a bubble waiting for a pin. But let's step back from the market mechanics and look at the competitive landscape, because you made a bold claim earlier about a monopoly. You are completely dismissing the 800-pound gorilla in the room, SpaceX and Starlink.
I was waiting for this. It's the favorite bear argument. But Starlink is a formidable launch company, not a direct competitor in this specific vertical, yet. Their direct-to-device proposition is fundamentally different.
Is it really? They own the launch vehicles, they own the Falcon 9. They can replenish their constellation faster and cheaper than ASTS ever could. I mean, if SpaceX decides to crush this market, they have the vertical integration to do it. They don't have to pay a margin to a launch provider. They are the launch provider.
But look at the physics. This is where the details really matter. Starlink's direct-to-device satellites are modified buses with significantly lower gain. They are focused on text and IoT, Internet of Things, initially. ASTS has a massive phased array aperture, the Bluebird. It is a giant flying cell tower designed for high gain. That means true broadband, voice, video, 5G data speeds. It's the difference between a walkie-talkie and a fiber optic cable. You can't cheat physics. You need a big antenna to talk to a tiny phone.
Okay, that's a compelling argument on paper, and have you considered the regulatory threat? T-Mobile and SpaceX are currently petitioning the FCC regarding power flux density interference. That is a technical term for your signal is too loud and it's messing up the towers on the ground. If the FCC rules that ASTS satellites are causing interference with terrestrial networks, that moat you talk about just evaporates overnight. If you can't turn the satellites on because they bleed signal into existing towers, the game is over.
That is a risk. I acknowledge that. But ASTS has designed their beamforming specifically to avoid that interference. That's the beauty of the phased array. They can steer the beams with incredible precision, creating nulls where the terrestrial towers are. And, let's look at the ecosystem. Google's Android 15 update is ensuring AST's readiness at the OS level. They aren't building this for a text messaging service. They are building it for the broadband experience. The industry is bending the knee to this standard.
Even if the tech is better, the valuation assumes ASTS wins everything. You have Global Star trading at $7.7 billion. You have Iridium pivoting with Project Stardust. You have Starlink already launching. The market is pricing ASTS at $42 billion, which is 5 times Global Star. That spread is massive.
Because Global Star is limited to SOS and text for Apple. That is a feature, a safety net. It's nice to have if you're stranded on a mountain, but you aren't going to watch Netflix on it. ASTS is a utility. Comparing Global Star to ASTS is like comparing a pager company to a cellular network. And regarding the valuation, if ASTS captures just a fraction of the subscriber base from its partners, AT&T, Verizon, Vodafone, the revenue potential dwarfs anything Global Star can do. We are talking about a B2B2C monopoly on the only global broadband connection to standard smartphones.
If. That is the most expensive word in finance. If they execute, if the physics holds up at scale, and that brings us to the operational reality. The entire valuation right now rests on the Bluebird 7 launch scheduled for late February 2026.
It is a critical catalyst, yes.
It's more than critical, it's an existential risk point. This launch uses Blue Origin's New Glenn rocket. This is a new vehicle. It's unproven compared to the Falcon 9. You are taking a massive payload, putting it on a rocket that hasn't flown commercial missions with this cadence, and hoping everything goes perfectly. If Bluebird 7 is delayed or, God forbid, lost, this stock doesn't just dip, it crashes. You cannot price a company at $40 billion when its immediate future rides on an experimental rocket.
I see the risk, but I view the move to Blue Origin as a strategic masterstroke. It diversifies them away from the SpaceX stranglehold. They cannot rely solely on a competitor to get to orbit. It's classic supply chain management. If SpaceX decides to prioritize Starlink launches over ASTS, ASTS is stuck on the ground. They need New Glenn. And regarding the tech on that satellite, the move to Block 2 satellites is huge. They are using custom ASICs, application-specific integrated circuits, instead of the old FPGAs.
For the non-engineers listening, let's clarify that. Why does that chip swap matter enough to justify a $40 billion valuation?
Think of an FPGA as a Swiss Army knife. It can do a lot of things, it's reprogrammable, but it's not perfect or efficient at any one of them. An ASIC is a scalpel made for one specific surgery. By switching to ASICs, they drastically improve the bandwidth per watt. It makes the satellite more efficient, which means more capacity, which means more revenue per satellite. It makes the unit economics work. It turns a science project into a profit machine.
That's valid technical nuance. But does it solve the manufacturing ramp? They need to launch 45 to 60 satellites in 2026. ASICs don't help you build the chassis faster. They don't help you integrate the solar panels faster. This is heavy industrial manufacturing, and they've never done it at this volume.
No, but the Golden Dome narrative helps the funding. You keep ignoring the dual-use defense asset angle. The U.S. government needs this to work for secure communications. That puts a floor under the execution risk because the Department of Defense cannot afford for this technology to fail. The SHIELD program isn't just a grant, it's a statement of intent.
The government lets contractors fail all the time. But I want to bring up something fascinating about how the market is pricing this launch risk.
Have you looked at Polymarket?
I keep an eye on it, but I focus on the fundamentals, not the betting pools.
You can't ignore it in 2026. The retail sentiment on prediction markets, literally people betting cryptocurrency on launch success rates, is becoming a leading indicator for the stock price. We are seeing a high correlation where if the crowd on Polymarket doubts a launch, or if the probability of a successful New Glenn mission dips even by 5%, the stock dumps almost immediately. We are in a weird feedback loop where gamblers on a prediction market are setting the price for a $40 billion infrastructure company.
That may be true for the short-term noise, but the institutional capital, the Stack prepayment, the Verizon investment, isn't watching Polymarket. They are looking at the spectrum rights. They are looking at the fact that ASTS controls the frequencies required to make this work.
But the price action is the noise right now. That's my point. The divergence from reality is driven by this gamified sentiment. If the betting pool decides New Glenn is risky, the stock tanks, regardless of what the engineers say.
I would argue the sentiment is following the reality of the engineering. The Bluebird 6 success was the turning point. The market realized, wait, this actually works. Now with the SHIELD Awards, the government has stamped it as critical. The smart money is positioning for the monopoly.
Let's wrap this up, because we are looking at the same chart and seeing two different worlds. For me, while the technology is exciting, and I admit the phased array is impressive, the risk-reward at $116 is asymmetrical to the downside. You have an RSI over 66, you have analysts saying the stock is worth 60, and you have a company that needs to flawlessly execute a manufacturing ramp that has historically bedeviled every space company, including SpaceX. We are trading on meme energy and squeeze mechanics, not the hard reality of $193 million in revenue.
And I see a market that is finally properly valuing a binary outcome that has tipped to success. Standard metrics like PS ratios fail here because they look backward or at the immediate future, not at the paradigm shift. ASTS owns the beachfront property of the sky. If they execute, and with the balance sheet de-risked by Saudi Telecom and the Defense Department, I believe they will, they own the only global broadband connection to the device in your pocket. The market is correctly pricing in a winner-takes-all terminal value.
Or it's pricing in a dream that's about to wake up to the cold reality of industrial scaling.
That is what makes a market. There is certainly more to explore here as we watch that February launch.
We'll see if the tower stands or sways.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.